Hi, I'm Jonathan Freed of the New York Fed. The financial crisis brought fresh attention to trading in derivatives and the need for more transparency in this market. Recently, a team of New York Fed analysts studied one component of the market, credit derivatives, to learn about the volume and frequency of trading. The team focused on credit default swaps, or CDS, a type of derivative giving protection to bondholders if an issuer experiences a bankruptcy or credit downgrade. Now, the findings of the Fed study aim to provide a framework for policymakers to consider when designing public reporting rules, one of the reforms required under the Dodd-Frank Act. Now, here with me to discuss the new study are two of its authors, Asani Sarkar of the bank's Research and Statistics Group and Kathryn Chen of the Markets Group. Welcome to both of you. Now, Kathryn, what led to your interest in this area?
Well, the CDS market, it's a large market, it's an important market, and what was really highlighted during the crisis was the opaque nature of the market. So because CDS transactions take place over the counter, in other words, privately between two dealers or a dealer and a customer, there's not a lot of information that's available about transactions. And this really led to increased counterparty risk concerns during the crisis.
Asani?
Well, the CDS market is soon going to move to a framework where trade details such as price and the size of the trade are going to be publicly reported. So what we hope is that our study will inform policymakers about some basic facts about the market, and this will help them implement the rules.
So, Kathryn, how were you able to study transactions in this kind of opaque market, a market that we just don't know that much about?
Well, we were able to work through a global supervisory group and obtain data from 14 of the global derivatives dealers and collect their transactions over a 3-month period. So this gave us approximately 90% of the activity in the derivatives market over a 3-month period. It's really unique in the terms of the level of comprehensiveness and the degree of detail.
So, the objective of your team was to draw a clearer picture of the CDS market. I'll throw this question to both of you. We'll start with Kathryn, though. What were your main findings?
Well, one finding was that activity was lower than we had expected. So take a given corporate single name CDS. A typical CDS would trade just twice a day. The most active traded just 20 times a day. So this is lower activity than we had expected. Another finding was the degree of standardization in the CDS market. We found that contract terms, the features of a contract, were quite standard, and even extending to the maturity and trade size, those were also very regular.
What else did you find?
Another interesting finding relates to hedging by dealers. So we examined whether dealers try to hedge their risk exposure by taking offsetting positions in the same instrument. And what we find is that hedging is quite slow, in the sense that hedging activity does not appear to occur within at least 2 or 3 days.
So you're saying that dealers are slow to hedge their positions. How are you interpreting that?
So one interpretation is that policymakers will need to carefully consider the implications of increased transparency on market makers. So in particular, once details of the trades are made public, other market participants will know about the trade, the price, and they might consequently take positions which move the price away from the market maker. So as a result of this, it might become more expensive for the market makers to hedge their risk. And as a result of this, the cost to customers might increase, or market makers may choose not to provide liquidity to the market. And these are consequences that policymakers need to carefully examine when implementing their rules.
So, Kathryn, what implications do your findings have for rulemaking?
Well, we think there's a mixed picture here. On the one hand, the high level of standardization of CDS contracts means that the information, when reported, will be well understood. Market participants and the public will be able to interpret the information. On the other hand, the low frequency of trading that we found means that there might not be significant price discovery benefits to price reporting. We do think that there are other benefits, though, that will lead to improved functioning of the market and improved robustness of the market.
Now, Asani, you look like you have something to add to that.
Yes, I would like to say that our study implies that there appears to be a trade-off between the benefits of increased information and the potential risk to market makers. Now, we do not know what the optimal transparency framework should be, but we hope that our study clarifies this trade-off for policymakers.
All right, Asani and Kathryn, thank you very much for shedding some more light on your study, sharing those details with us today, and thank you for spending time with us and watching this New York Fed video.